Okay, so today we're going to be talking about the weekly high or low liquidity grab strategy. And the topics we're going to cover, firstly, our market structure, marking up the weekly high and low, and a case study. This happens over and over again, so there's been many case studies. We'll go over one today, just to keep it short and sweet. Firstly, what I want to go over is market structure. So what we mean by market structure is how the market is flowing, how it's trending at the moment. For example, if it's making higher highs or higher lows, or lower lows and lower highs, that determines whether you're in a bullish market, so a market that's going up, or a bearish market, which is a market that's coming down. So, for example, if we have a market like this, it's making higher highs and higher lows, higher highs and higher lows, etc. That's a bullish market. But what we want to look at, because the way that we are aiming to trade is in an institutional, using institutional methods. We don't want to be trading sort of in this area here where you've got the retracements down to 50%, etc. If you're using your Fibonacci, we want to be trading the positions where it gets to these weekly highs and lows, and this is just one of the strategies where it gets to these weekly highs and lows and does a liquidity grab and reverses. Now remember, when it gets to a weekly high, if the market's bullish, it doesn't mean that it's going to reverse. You will often get some sort of a reaction. It could be, a small reaction. For example, let's say the weekly high is up here. Once it takes that, so it comes down, it takes the weekly high, then you might see it go down like that and then carry on up. So you'll get a small reaction on that weekly high. So here, for example. And what we're looking for is the movements here to be able to give us the opportunity to enter on a sell, however short term it may be. So if it doesn't give us the opportunity to enter, so if it doesn't meet our entry requirements, then we won't enter. It will just carry on going up, for example. And this is one of the most important things with trading, is that just because it takes out a weekly high or a weekly low, it doesn't mean that we're going to enter straight away. We're going to wait, and we're going to see what happens. And if it gives us the opportunity to enter, then we will enter. So let's say down here, we've marked up our weekly low is here, yeah? And this was Friday, let's say, yeah? On Friday, it's come up, it's gone up. Monday opens, goes off. Sunday evening it opens, it carries on going up. Then on Monday it keeps going up, maybe consolidates a little bit on Tuesday, then starts to come back down on Wednesday. And then on Thursday, it takes the weekly low, so the previous low of the week. What we are looking at here is for it to reverse at this level. Now, like I said, it's not going to always reverse at this level, and it could just keep going down. As you know, this week was extremely bearish on GU, and that's largely because it was on the final stages of a Wyckoff schematic, which we've marked out in the group. So once it gets to here, we're going to look for it to start to make higher highs and higher lows, okay? And once it's made those higher highs and higher lows and it's broken that structure, then we're going to look to enter. Now, if you're looking at the trade from a 1 hour perspective, just here, you're looking at the trade from a 1 hour perspective, so each candle is 1 hour, for example, you're not going to get enough detail to be able to enter. So what I would suggest is, if you can't keep an eye on every chart, I would suggest you set an alert for it when it comes here. When the price gets down to here, you're going to get a ping right here. You're going to get a ping right here. That's going to alert you. Then you're going to hop on the charts and you're going to watch to see what happens. Once it gets to the weekly low, the previous week's low, and takes that low, then you jump down into the 1 minute, the 3 minute, possibly the 5 minute. But for those pinpoint, 3, 4 pip stop losses, 2 pip stop losses, you're going to want to go on the 1 minute time frame. So you go down onto the 1 minute time frame, and what you're going to see, what you want to see, is it come down to take that low. Yeah. Let me just draw the low in for you. So for example, this is the low. We've zoomed in now. We're down at the 1 minute now. We've zoomed in. So price on the 1 minute, on the 1 hour, it's going to be like just one big candle coming down, okay? But on the 1 minute, it's going to do lots of this. Lots of candles going up, down, with a micro trend forming. And it might even come down to here and go up a bit, and then it'll come down. So let's say each of these points here is 1 minute on the chart. So it comes here, goes up, then breaks it. Okay. What we're looking for at this stage is for this high here to be broken. Yeah. This is the high that made the low. Okay. This is the high that sponsored this breakdown to break the previous week's low. So this high here is significant, okay? What we want to happen here is for it to break that high. So it could continue down for a little bit, it could carry on down, yeah? But we want it, well, let me just to simplify it. Once it's carried on down here, if it comes back up, then like we said, we're not predicting the market here. We cannot predict the market. The market does what it wants. Well, the market makers make the market do what they want, and the algorithm of the market means that it does what it wants. But so we can't really predict the market, but what we will do is react if it breaks this high. Okay, so we're using this key point of interest, which is the weekly low on this occasion. We're using this, and we're saying once it's taken that low, we're going to see a reaction to the upside. And why that is because underneath every week's low, there's going to be liquidity. And by what I mean by that is, under here, under this low down here, people are buying. Yeah. Why are people buying? Why do we know that people are buying? Because once it hit this low, it never came back. So at this stage, people are not selling, people are buying. Okay. So there's lots of buyer stop losses here. You've got lots of liquidity here. Yeah, so you've got to imagine people at this level, they're buying up. Yeah, however many people, thousands, if not hundreds of thousands of people, millions, if not billions of pounds or dollars are in buy positions here, and their stop losses may start off at 20 pips, 30 pips, depends, but I would say the average retail stop loss is probably going to be about 20 pips. However, obviously the main element of trading is to protect your capital. So once you have seen, a big move up, so look, for example, 70, 80 pips up, you're going to move your stop loss to break even. And this is why people might wonder, well, if people's stop losses are 20 pips, why are we just seeing a small break here of maybe 5 pips, a small break up here of 5 pips? And that's because people have moved their stop losses to break even, so to their entry point, so to the point where the market went up, started to go up. So their stop loss is now on this blue line, which is the weekly low. Some will even have it slightly above because people will put their stop losses into profit to make sure that any sensible trader will do that, to make sure that if the market does come down, at least they're rewarded a little bit for their hard work. You'd hope that they would have taken profit as they went, but again, not everybody does, and they will hold for a lot longer. And the strategy that we use is intraday trading. So we will tend to hold a position for a day, possibly overnight if we're well into profit. So at this point here, it's broken the low. We now know that people, so if you think about people, think about their psyche, they don't want to lose, so they move their stop loss into the break-even area, which is sensible trading. That's what's taught in every course. So that's how you know people are doing it. We've seen the break of the low. The market has taken out those buys. Now remember, for the market to continue up, it needs to take people out of their buy positions. Why does it need to take people out of their buy positions? Well, because for every buyer, there needs to be a seller. For every seller, there needs to be a buyer. So what I mean by that is, I use this analogy a lot, but if you've got 100 apples and you've got 200 people that want to buy, only 100 people only 100 people are going to be able to buy those apples if they're going to buy one each. So just like any economy, there needs to be one buyer for every seller. So what the market will do, and you'll see this a lot, people wonder, why does it keep coming back and stopping me out? It's not malicious, it's not aimed at you personally, but for the market to work, the market needs to take, if there's too many buyers, the market can't go up because there's nobody selling, because everybody's buying. And for someone to buy, there needs to be a seller. So what you'll notice in the market is that it'll come out, it'll take people out of their position and then move up. So it takes the buyers out of their positions, which make them sellers. So once they're in their position, they have their stop loss at, for example, in this occasion, they have their stop loss at 1.59896. If at that point, when they get taken out their stop loss automatically sells their position. So that means there's an influx of sellers. Hence why you see then the big institutions get in and buy up price drastically. So you see the drastic move, and this happens a lot. So let's get back to this. So it's taken out the liquidity now. Now we're waiting for this high to be broken, okay? So as soon as it breaks that high, it's broken that high now. We've got our confirmation here that price wants to go higher, okay? And normally, and I've said this many times in the mentorship, if you're looking at the 1 minute, there's heavy manipulation on market structure, okay? So I wouldn't necessarily trade market structure and say, okay, when there's higher highs, higher lows, I'm going to buy, because again, manipulation is occurring. There's higher highs, higher lows, for example, and then price will just drop down. You say, but market structures are going up. Market structures going up. Why has it shot down? And that's again manipulation. That's again the market, the algorithm of the market needing to get rid of those buyers so that it can move up. So our aim is to get in after the actual manipulations happened, okay? So we're not looking at market structure to enter. We are looking at the fact that it's taken out the low. That's one of our confluences. Now, market structure has occurred. Market structure has been broken, sorry. And we're not just going to get in here. We're not just going to put a buy here, right here now. It's broken structure, right? I'm buying. And because in the group, everyone who knows, in the group we have 3 pip stop losses. I guess the average stop loss is 4 pips. Obviously we're on the weekly here, but a 4 pip stop loss is tiny, yeah? Because what's going to happen is price is going to come down. Where we enter, and I go into more detail on this in the mentorship, but where we enter is here. This little candle here. Yeah, remember each segment here is a candle in our diagram, okay? We're looking to enter on a retracement back to this candle. This is the institutional candle or the order block. There's many names for institutional candle, order block, or we are looking to enter at 50% of the last down candle. Okay, 50% of the candle that took out the liquidity. Okay, the candle that took that liquidity out. So we're looking to enter the same place on this occasion, and that's what you'll find most of the time. There'll be that 50% of the last down candle, or up candle if it's the other way, or 50% of our order block or institutional candle, whatever you want to call it. Okay, so we're going to enter here. We're going to have our stop loss just below that candle. That's why we get such small stop losses. Or you can have, if you want to be slightly more conservative, you put your stop loss just under the low of the last down candle. Okay, now if you're right on this, then obviously we're going to see a big push up, and that's what we're aiming for here. So what we're aiming for is for price to come back down here, tag us in, and then keep going up. Yeah, and that's the structure that we're looking for. We're looking for the high that made the low to be broken, and then we enter on the institutional candle, 50% of the candle, and ride it up. Okay, now obviously no strategy is 100%. Okay, if anyone ever tells you it is, then most of the time they're lying. Well, all of the time they're lying, sorry. This could still happen. You know, it could take out the weekly low. It could give you all the market signals, you know, breaking the structure to the upside, coming down, tagging you in, going up, and then it could just go all the way down. All right, and the reason for that is because the market itself is overall bearish. Remember, on the 1 minute time frame, and I said this, I've said this again many times in the mentorship. 1 minute time frame structure is unreliable. Okay, so you'd want to see on the hourly, the half an hourly, the 4 hourly to get your overall bias of where the price is going to go up or down. However, these are trades that I would enter purely because it's taken out the liquidity of a weekly low. It's given me my entry conditions, and I'm going to ride it up. Now, as long as you listen to the strategy, you obey that strategy, and you don't deviate from the strategy. So what I mean by that is you try it 2 or 3 times, it doesn't work, and then the next time you try something different in the same position. That next time is that time that the strategy would have won. And with such a small stop loss, 3 pip stop losses, 4 pip stop losses, 2 pip stop losses, you're going to, even if you lose 4 trades and win 1, you're going to lose, say if it's a 3 pip stop loss, you're going to lose 3, 6, 9, 12 pips, but you're going to gain 50, 60, 80 pips if you win. So that's why people that say, you know, I've got a win rate of 100%, 80%, it doesn't matter. If your win rate is 30%, but you manage your risk correctly, then you're overall going to be a trader that is successful. So that's market structure. All right. What we're going to have a look now is how to mark up a weekly high and low. Okay, and it's very simple. Literally, you go on the weekly chart and you mark it up. Now, obviously, we're looking at things in hindsight here, and people that are going to watch this are going to think, oh, well, this has already happened. It's easy to see. But you can look at it every week and you'll be able to see it. So I'm going to just go on last week just to see what happened. So we'll mark up. All you do is you go up here to the little drawing tool. You go to horizontal ray, and literally you just mark up last week's low and last week's high. Now, they don't always need to be taken, both of them, but some weeks it does happen where they take both. For example, this week here, the previous week the week after took the low and the high. Okay. This week here didn't take anything. If you've been following GU, you'll know that it's been consolidating for the last few weeks here. That's why we've got this 4 candles here that are basically in the same position. It's been consolidated. In another video, we'll cover this. This was a huge Wyckoff schematic that played out. And it's played out beautifully because what you want to see from a Wyckoff is once it beats those last lows, it flies down. And that's exactly what happened. But we'll cover that in another video. So once you mark them up, you can just write on them, you can put weekly low, weekly high. You can also do this with the high and the low of the current week as well, because it does work. So we've marked up the weekly high, the weekly low. Now let's go down into the, let's go to the 15-minute for now. Okay. So let's just have a look. So this is the previous week. Right here. Okay, so this is the week that's just passed, and you can see this big down trend that's happened. And this is the previous week here. Okay, so you can adjust it here if you want. That's the weekly low right there. And the weekly high is right at the start of the week, which is about there. Yeah. Actually, it's about there. That was the previous week, previous week, sorry. So we've got the weekly high, the weekly low. And what we're looking for here is for that weekly low to be broken for us to then take a move up. Now, what you would have known, and again, we've gone through this in the group, in the mentorship over the last couple of weeks, GU currently is overall bearish. Now, until just this week, it was slightly bearish, but you could see it here making, just get the right, making higher, so lower lows. Yeah, every week the highs have been getting lower every single week. Every few days the highs are getting lower. Yeah, I'm not going to mark them all out, but you can see here they're getting lower, and obviously it dropped off. So you can see that we're in a downtrend. Even the lows are getting a bit lower. Getting a bit lower, getting lower, and then obviously it drops off. So we can see that we're in a overall downtrend, slight downtrend, okay, but you can see it. Now the key area here that we're looking for, and this is what we would do. So we would set an alert for when price was to get to around here, okay? And if you don't know how to set an alert, you literally just hover over there where you want, right click it, add alert, and then you can customize it to whatever you want. Okay, so you're going to say, you know, weekly, you could just say maybe approaching weekly low, approaching weekly low. Okay, and you just create it, and that's it. And then as long as you've got the app and it's set up on your phone, you're going to get a notification to tell you it's approaching it. And that doesn't mean we're going to jump in and enter, but what it means is when it approaches it, because you see here, it's approached that low and it's gone up. Now, I'm not going to go into this particular one for the purpose of this video because it didn't break the low, but you would have had signs in here where you would have been able to take it up. But for the purpose of this video and for the purpose of this strategy, we're looking here where it's taken the weekly low quite drastically. I think it's 1 15-minute candle, done a reversal, and then went up. So we're going to highlight this area. This is the area we're going to look at. And obviously this is in hindsight now. In hindsight, everything's a lot easier. When it's live, it's harder, but when you back test it a lot, that's when it becomes easier. When you've tested things and when you know what you're looking for in your strategy. So as simple as I can make this, We've got the low that's been taken. We've got our alerts set so that if that low's taken, or if it gets close to the low, we're going to be watching the charts. Okay, we're watching, we're waiting, we're not doing anything, we're not reacting, just yet. We're waiting. Okay, and this is the most difficult part in trading. Anyone who's traded will tell you about their mentality and about how they jump into trades for no reasons, and they get excited because it is exciting. Trading is something that you can get hooked on because you can make so much money from it. Let me just remove that. Lovely. Okay, so we're going to zoom in now on this. Okay, so this is where it's broken the low. So let's go down. I like to trade on the 1 minute. Some people prefer the 3 minute. I do the 1 minute just purely because it lets me see things, okay, that you wouldn't necessarily see. Okay, so the first thing we're doing here, you can see here, let me just make it a bit bigger for you all. There we go. Lovely. So we can see here, this is the low. The blue line is the low of last week. It went. Now, support and resistance traders would have been trading on this. Yeah, they would have been buying from here, trying to buy. Every time it tapped this line, they would have bought. And now every strategy works. Yeah. So early on in the week, when it tapped this line and they bought, they would have made, they would have got some pips, 50 pips, nothing huge, but they would have got some pips. Yeah. To be fair, 50 pips is more than enough. If you're trading good lot sizes, it's more than enough. Now, but on this occasion, it's broken through that. Now, people would have been buying here and they would have, unfortunately for them, been taken out of their position. Why? Because too many people are buying here and the big institutions require sellers. They need sellers to be able to buy up. Yeah, if that makes sense. If there's no sellers, they can't buy. And remember, institutions are not like us, they're not trading 0-1 lots or 1 lots or 2 lots or 3 lots. They're trading big lots. Okay, remember, there's a huge amount of money, trillions that go through the Forex exchange on a daily basis. So they're trading massive amounts. So back to it, it's crossed this line quite heavily. You can see that they've needed to push through that quite heavily. Otherwise, it could have continued up. Okay. Now, what you might be thinking from what I said earlier is that we're looking for this high here to be broken. Yeah, we're looking for this high here because this is the one that beat this trend line. That beat this weekly low. This is the high that beat the low. However, it continues lower. Yeah, and there's another low that's made, another high that is made. That beats the low, and even there's another one right there, and even here there's imbalances. If you're to go down to the second ones right here, there'll be some sort of there'll be candles right here, buy candles right here. Okay, so you've got different highs here. Now if you see here, it comes along this line, it goes up here, and obviously we know we're in a Wyckoff schematic, and this is why it pushed down so heavily. Okay, so what you would have been looking for here is an entry here. Now I don't know, let's have a look if we can get down to 30 seconds, whether it works. This is going to be a bit too much, I believe. Yeah, it's not showing the drawings, like it's okay. Let's go back down to the 1 minute. The market's just come on as well. Okay, so what you're looking for here on the 1 minute is for this high to be broken, and then for it to retrace down into your 50% of the last down candle before going up. Now, as you see on this particular occasion, it didn't actually come back down. And I believe in the group, we did have an entry here. We did have a buy limit set. So what we did here, and this is just to show you that not every trade, regardless of your strategy, not every trade is going to work, okay? Even though we didn't lose here, we weren't tagged in, and it was quite a nice gain. So what we were looking for here was for 50% of this down candle. You'd class that continuing down to be come back and tapped. To be come back and tagged, and we would have had our entry right here. Now, what you see on this occasion, you could have had a stop loss up here, or you could have had it just below that low, okay? On this occasion, it didn't come back. However, what you see here is this big reaction. Remember, we're in a bearish week here. We're in a bearish week, but we got potential of up to a 90 pip move, okay? In a bearish week. We've hit a 90 pip buy in a bearish week. So, this one, unfortunately, we wouldn't have got into. However, what we can also do is trade the high of this current week, okay? So remember what I said, we look at the high and low of the previous week, and also the high and low of the current week. Because of each of those, there's reaction, okay? And the high of this current week, because this is Sunday, is here. Yeah? Hopefully you can all agree. The high of this current week, and this was last week, is right here. Right here. And we could have looked for the exact same thing here, okay? So it's beat the high, we can see that. Just make it a bit big. One second, guys, there we go. Sorry, so we can see, so we've got the high of this current week. So we mark up the highs and lows of the previous week, the highs and lows of the current week as well, because it's the same principle applies, okay? So the high of this week was here. Every time it makes a high, there's a retracement back down, okay? Because it's taking up liquidity. Yeah, that's what you'll notice. So it will go above that and then drop down. So this is how you could have gotten this move. Remember, your overall bias is, from the group is a sell, is a bearish bias, because we're in a Wyckoff schematic, and also because we're making lower lows and lower highs, as I showed you earlier. So here, we've got this big push up to take out the current week's high. But what you see here is a low right there. That needs to be broken. Let me just enlarge it a little bit, because it's very subtle on the 1 minute a lot of the time. So there's this low that needs to be broken. Now, we don't look at the wicks, okay? For breaks of structure, we only look at the bodies. I'm going to zoom in so you can all see it. Right there. Right here. I'll just need to zoom in even more, because it's such a subtle one, this one, but it's still a break, okay? I don't know if you can actually see on this. On this broker, it looks really even. Let me go up to this broker right here. This is the broker we normally use. FXCM, I believe they are. Yeah, FXCM. 1 second, let me just go back out. Go to the 1 hour for you all. I'm going to get rid of all of these markings. Right, okay, right here. So we've got the high of the week. Now, obviously, you'd be doing this live. So you mark up the high of the week and the low of the week. Each time it changes every day, yeah? So you've got the high of the current week. Again, you set your alert. Right click, add alert. Breaking current high week, yeah? Create it. Once it comes up to here, it's going to alert you, okay? I'll delete it just because we don't need it. I just wanted to show you how to do it again. It's broken the high. Well, you've got your alert. This is the area we're going to focus on. Right there, yeah? Let's zoom in now to the 1 minute. And right here, yeah. And we normally, well, I always use this FXCM chart. For me, it seems like the most accurate, and maybe just works best with these strategies. Can you see how they look slightly different? Okay, right. This right here, can you see right here? Here you can see that's the low that sponsored this new high. So this is what we mark up. This is what we will need to be broken. Now, like I said, when you're on the 1 minute, these are going to get broken all the time. And it doesn't mean that it's changing around, but because it's taken out the high of the week, it's done a liquidity grab, yeah? It's taken out people's positions. We're going to mark it up and we're going to look to enter here, yeah? You can see there, here, it's taken it and it's gone back up. This one you'd have to be so quick on, and this is why in the mentorship we can't always put a signal of what we are trading through because of this, because of how quick it happens. Yeah, you see it's broken. It needs to, it's not just the wick, it has to close below it. Okay, so remember, it's not the wick, we ignore the wicks. Okay, it has to close for a breaker structure. It needs to close below the last low and the low that made the high. So what we do, same thing, we got our Fibonacci 50% from the low to the high, and you could, yeah, you would count that because that's actually the lowest point before it goes up, yeah? So just remember, you always count that previous candle's lowest point before it goes up to the highest point, okay? Even if you didn't, you could just go take into account the green candle right there. So you mark up your Fibonacci green candle to the green candle. You would include the wicks, as I said, and you enter, okay? And it's pinpoint. It is pinpoint. Let me just make sure that we got it correct. Like that. And this is why it's very important that you mark up when you're doing these things. You do them properly, okay? So you can see here, it breaks it and it retraces up to probably a micro pip away. And what I always tell the people, everyone in the group, is that we just go in sort of 75% normally, okay? 75%. Stop loss would probably be here. You could, if you wanted to be a bit more aggressive, just have it above this candle, which you can do. And on this occasion, it doesn't get anywhere near it, but you can have your stop loss just above this candle, or you can have it above the high, the wick, the high of the wick. Like I said, if you want it to be a bit more aggressive, you just take into account the last up close candle, okay? And we write it down. And the reason we do the 75-ish%, so about here, is because it does this sometimes, okay, where it sort of just about doesn't tag you in, and depending on what type of account you've got, what type of broker you've got, the spreads may not tag you in. So if you allow yourself a little bit of breathing room, obviously you have to have a slightly bigger stop loss because of it, but you know, this is not even a 4 pip if you're just at the high of the last up, and not even 5.5 pip if you're at the very high, okay? So they're tiny stop losses. And what does that mean? It means that you can have better risk to reward. So for every, you can risk more because you can Whereas, say for example, if your account was, you would normally risk a one lot with a 10 pip stop loss. For example, if you've got a large account size, a one lot with a 10 pip stop loss. On here, you've got to remember we've got half of that, so we could risk 2 lots, but still only risking the same amount of pound note and percentage. Yeah, that makes sense. So now you write this down. Very small breaker structure here, tiny micro structure, and you'd have to be watching this, okay? And this is how this type of trading is. You need to watch it. You set your alerts. Once it gets to the area, you watch it, okay? Because if not, you will miss the trade, unfortunately. And this happened all within making the high to coming down, breaking the low that made the high, retracing up to just below 50% before dropping. That will happen within 1, 2, 3, 4 minutes, okay? 4 minutes, yeah? So you'd need to, that's why you have to watch, set your alerts, set your highs of the week, set the lows of the week, set the high of the previous week, set the low of the previous week, okay? And that's your targets. That's where you're targeting liquidity, the high of the week, the low of the week, the high of the previous week, the low of the previous week. Also, monthly high and monthly low. Those are that's what you're targeting, okay? Now, the principles apply, it's the same thing, monthly high, monthly low, weekly high, weekly low, sorry, previous weekly high, weekly low, and current weekly high, weekly low. They're all the same. So we go here and we write it down. Now, obviously, there was a huge sell-off. So if you got in here, you could have, you know, the overall it's huge. The overall area you're looking at over 300 pips in 3 days. Okay, it's huge. Now remember, obviously we're intraday traders, so we're going to target smaller areas. Okay. Now, whenever we're in the mentorship, I always tell the participants to obviously take profits at relevant areas of liquidity, but also leave a small amount to run so that you can take these massive moves and benefit from them. And that's not to say you can't leave it all to run, which you can, because on this occasion we were in a Wyckoff, the last stages of the Wyckoff, so we could have we would have been expecting something like this. However, if we weren't in that, then we would have been taking some profit at this level, at these lows here, okay? Why would we take profit at these lows? It's for another video, but quickly, just here, we've got this form of support, okay? Quotation marks, support, which we know need to be broken. Support resistance always gets broken. So the reason that it needs to be broken is there's money sitting under here. So we want price to come down, take this money, we take some of our profits. You may have taken some money higher up, depends, but even that's 57 pip move in the space of, what we're looking at here, about 6 hours. And to be fair, on this occasion, once it took this, you probably wouldn't have been able to take your money at this level because it flew down. So you probably would have taken profit somewhere here where it started to do this little retracement. You would have taken some money off here, which is 100 pips in 6 hours. This is how powerful this type of trading is, because you're looking for the key zones of reaction. You're getting in when there's breaks of structure. They're very micro, but there's breaks of structure. And then you're riding it down to relevant areas. This would be the sensible area to take some money. 50%, 80%, depends on yourself and what lot sizes you're using. But if you're using a decent size lot size, you could take 50% here and let the rest ride down, because like I said, we are in a Wyckoff in this particular trade. We would have been expecting quite a big push down. But if we weren't, you might have taken 80% at this level and let the 20% ride. Okay, remember those 20%, they all add up. So if you've got a few of these going, 20% could equal one whole trade. So that is how we look for the weekly high, or the previous week's high, or the previous week's low, and we play off of that. Now, as I mentioned on this here, we entered, we got in. Unfortunately, if we get to this one, and it happens, you're not going to get into every trade, no matter what strategy you use. So if anybody tells you that you are, then they're most likely selling you a full stream. But this is the week. That was last week. Yeah. So this was the weekly low right there. So I've marked that up, the weekly low. Let's get back down into the 1 minute. Yeah, so the weekly low was very, very close to this, but this is the weekly low, and unfortunately on this occasion it didn't give us an entry. Okay, although it did everything, it came down, took the weekly low, which is this blue line here, took the weekly low with force, consolidated a bit. This is the high that needs to be broken. Remember, we don't take into account these wicks. These are the highs that need to be broken. These ones right here, the high before the push down. So these are the highs that need to be broken. Unfortunately for us, it came down. When it beat that high, it never retraced back down to our institutional candle, and it went up. Okay, but the principle is the same. You see how when it beat this low, market structure changed and it continued up. Now that's not to say that you couldn't have got in further up, because there's positions where you could have got in, but for this particular strategy where you're looking for it to beat the weekly low or the weekly high or the current week's low and the current week's high, or the monthly high and the monthly low, we're looking for a change of structure, break structure to the upside, and retracement down to our institutional candle, 50%. We mark up. Like I said, I normally enter at about 75. If it's a very small candle, then I'd enter at the start of it. Trading isn't, your entries are not going to be exactly the same each time. A good trader is going to adapt to what they see. So for example, if this particular candle here was our entry candle, this was our institutional candle, for example, it's such a small candle, 2.7 pips, that you'd probably have your entry at the start of it, and your stop loss just below it if you wanted to be a bit more risky, or just below that low if you wanted to be a bit more conservative. Okay, so if it came back down to this candle, obviously you're going to get in at the open of it instead of 50%. The reason you would change it to the open of it is because sometimes price does just tap it and then go, instead of coming down to 50%. So you just adapt, and if you can maintain your risk level, so how much you risk per trade, then you can enter at the start of it. If, however, it's a bigger candle, for example, if you're entering off of this candle, just as an example, if you entered at the top of it, for us personally, and for me personally, the stop, that's the low if you want it to be a bit risky, but the real low that if you want to be a bit conservative is 10 pips. So for me, I wouldn't enter at the top of that. I would enter at about 50% to go down. 7.5 pips, even for me, is slightly too much. But all you do is amend your lot size to the relevant size so that you keep your risk at 1%, 2%, 2.5%, whatever your trading plan says. Okay. So on this occasion, unfortunately, you wouldn't have got in, which is fine. It's normal. Just don't chase it unless you see a relevant entry in it from a previous, from another strategy, another institutional strategy. On this occasion, you would have entered. It would have been beautiful. You would have caught some huge. It's a huge move that actually happened. But even if you just took it to this area here of supposed support, which has been manufactured. This support has been manufactured to take this high, okay, to take this high, to take the sellers out of their positions up here, because they've seen this big push down. They're risk-free in their trade. They're putting their stop losses into a bit of profit or into break even, so that they don't lose, because it's gone down from here down to here. It's 90 pips, so they would have risk-free their trade. No point in keeping their risk on the table, not expecting it to come back up as it did over a day. This support was manufactured so that they could get the buyers to come up here. The market takes people out of their position and then it drops off. No coincidence that it didn't drop off here, because too many people were selling. Too many people are selling. It means that the market can't go down. Okay, so you might have got in it here. You may have got in it here. If you're a longer term trader, you would have probably not taken any profits. If you're an intraday trader, lovely trade, you would have taken your profits and ran. However, if you're you trade over a few days, weeks, whatever, and they would have come back up, because the entry is good, but there's too many sales going on. So it's not, manipulation doesn't mean that they're coming after you. It's not personal. It's just that the market can't work. Okay, if there's too many sales, the market can't go down. Likewise, if there's too many buys, the market can't go up. So it had to come back up, manufacture this support, take out people, and then drop. And it's no coincidence it dropped so heavy. Okay, I believe there was a news event here, but news events are used to, I think the news event was a bit earlier or later. News events are used to push the market quickly as well. Okay, so yeah, that's two examples there. One, unfortunately, there wouldn't have been an entry. Two, a huge entry. This buy here would have been short term for us, just targeting this, because we know how the market works. We would have targeted these highs here, and then we would have looked to get in on a sell. So the market was moved drastically last week, and that's how you target weekly highs, or current weekly highs, current weekly lows, monthly highs, monthly lows, and the previous week's highs and previous week's lows. Now you might be thinking, okay, so that's the weekly low, so I'm going to target this now. Yeah, and like I said, unfortunately sometimes it might give you that and you get taken out. On this occasion, it took out like I said, we were looking for this big move down, so we wouldn't have been looking for a buy here, but it came down. It took just for the purpose of the video, it took the low, the weekly low. Yeah, it went up. Now let's see, it's a bit of a mess here, but probably the high that you'd be looking for to get broken would be this one. Yeah, it'd be that high that you'd be looking for to get broken, and then in retracement to 50% of here. To somewhere here with your stop loss just below or just below here. However, because like I said, not every strategy works every time. If you did get into this, but obviously in the mentorship we combine a lot of strategies, and we were looking for this massive push down. You might have, if you weren't, if you were just trading on your own, based on this video, you might have entered here. Trying to ride it back up. But remember, it's been such a massive drop down that it's quite risky. It's a very risky trade, this. And unfortunately, you wouldn't have had a chance. It would have taken you out straight away without. I mean, yeah, a few minutes passed. Obviously, here there was some consolidation, but you would have just got taken out. So, just on this little clip here, you can see you've got in the space of let's say 2 days, a day and a half, you've got this entry here which took out the previous week's low, went up, didn't give us our entry, so we wouldn't have entered. Based on other strategies, there was other entries, but that's for another video. So we wouldn't have entered here, so we've got nothing here. No win, no loss, nothing. Yeah, and we're, you know, at Nurture FX, we're very honest. Okay, we know that trading, you're not going to win everything, but here you would have won this beautifully. So failed entry here because it didn't come back. Fine, fantastic, doesn't matter. Beautiful entry here, and like I said, you would have taken profit at about some profit at 58 pips, but you would have had a runner. Okay, so you'd be just leaving that money to go until you really do get a breaker structure to the upside, and not on the 1 minute, more like on the sort of 15 minute. Once you get that, it's a little bit more assured that yeah, you're going to hopefully continue up. So you would have still had this. So you might have thought, you know what, I've still got the runner here. It's worth the risk. I'm going to try and see, okay, it's taken out the weekly low. Let's see if it retraces up. Now remember, the only reason we wouldn't have taken this trade is because we've seen the Wyckoff schematic that's we're looking to play out, but we're also in a downtrend. When you're in a downtrend, it's best to look for sells. When you're in an uptrend, best to look for buys, okay? Instead of trading counter trend, which is a little bit more risky. So here we would have still had the runner. If we took this one, we would have lost. So unfortunately, if we took this one, which we didn't, but if we did, you would have had a loss here. If you were just applying the strategies based on this video, just this single strategy on its own. One, nothing, didn't tag us in. One massive win, one small loss. You see here, 6.8 pip stop loss. So if you're using a one lot, you've lost £68. If you're using a one lot here, if you, for example, took 80% of your one lot, believe it was 50, yeah, just here, 55 pips. So a one lot here would have been £550 on 55 pips roughly, depending on your leverage and stuff like that, but just roughly £550. If you took 80% of it, let's say you're looking at about £410 you would have taken. So you would have lost £68 on the last trade, but you're up £510, plus you've got a 0.20 lot running, down to as low as you want to hold it, most likely down to the monthly low, because we want to target the monthly low because we're in a downtrend. We're at the last stages of this Wyckoff schematic as well. So you see here, one nothing, one huge win, one small loss, and that's the beauty of managing your risk. That's the beauty of not trading retail in the retail ways. But what I mean by that is having your entry here and having a 20 pip stop loss, 30 pip stop loss, whatever they want to have, 40 pips, but I think the average is about 20 pips. Yeah, to be fair, might even be a bit lower than that. It's probably going to be, yeah, I mean, I would say probably a 20 pip stop loss on this occasion. You're just going to get taken out. You're going to lose, if you've got a one lot, you're going to lose £200 there. The beauty of this style of trading, you have a very small stop loss. I think it was 6 point something pips. Tiny stop loss. So if you lose, you lose. You know, as long as you don't keep jumping in, and you manage yourself, you manage your mentality, and you stick to the rules. Even if you don't get in on one, win big on the other, and lose small on the other, you're up by, well, you've banked over £500 and you've still got a runner, probably sitting at £150 at least, and you've lost £60 there. So you're still up £550 just in a day and a half's trading. That's if you use a one lot, okay? If you use different lot sizes, that's going to differ massively. So that's it for this video. I hope you took some value in it and it's going to help you with your trading. Just remember, mark up the weekly highs, the weekly lows and highs of the previous week, and the monthly weekly lows and highs, and those are your targets. When it gets to that area, so you're not trading until it gets to that area on this strategy, you wait for them to get to that area, you set your alert. When it triggers your alert, you watch the chart, you wait for the liquidity to be taken, so the weekly high, for example, to be taken, as is what happened on this example here. Wait for the weekly high to be taken, wait for your break, mark up the low that sponsored that high to take out the liquidity. Once that low gets broken, you look for a retracement back up to our institutional candle, 50% of it, and then we write it down and we take profit at relevant and logical points where there's liquidity. Okay, it's nothing worse than doing all that hard work, getting in on a trade, and then seeing it come back, clear this money, then come back up, take you out, and then go down. Yeah. So that's it for today. I'll be making many more videos. Hopefully you take value from this, and I'll see you again soon.